Okay, welcome everyone, and thanks for making it to this session, prepayment of super contributions. We want to go in today. I'm going to have a really good look. This is, again, all the information we sent out. It's a very, very timely presentation, and more importantly, it applies really up to 30 June. It's the sort of stuff that you can't do a prepayment. Unfortunately, the way the superannuation laws go, you can't do a prepayment in, say, May or December or whatever. It really needs to be something that is focused in on June and then is carried forward to the next year. So much the same way as the prepayment rules effectively have a position that you've got 13 months that you can prepay, and hopefully, if you listen to my good mate Tim Munro and etc., that effectively you'll be in a position of making sure your clients prepay your accounting fees next year, although that also has a disastrous impact. If they prepay, then you have to bring it to account in your assessable income. But let's say this is also going to apply for you as well for this year. So I'm going to take you through, we're going to have a look at a whole range of issues. I'll cover a few little things coming up for us at LightYear Docs, and particularly a couple of things tomorrow, which I think is pretty exciting. But really, from our perspective, each year 30 June comes around, and I've heard so many seminars just recently on the use of the instant asset write-off, which, let's face it, it's okay, but you end up with, unless you really need the asset, which generally is depreciating, unless it's a used car these days. Effectively, there's you've just got these assets that's sitting there. I'd rather be able to get a deduction and then effectively use it to buy investments, whether it's a property through an LRBA in our superannuation, or invest in the market, or just hold off waiting for the market to fall to invest. It's exactly the same thing. An instant asset write-off is you get a tax deduction for a capital contribution. And what's super? You get a instant deduction for a capital write-off. Well, not a capital write-off, but a capital contribution, which you're effectively going and investing for your benefit of your family, which is really crucial. Most of us scratch around, and of course, superannuation is that last minute thing that we get into. One of the ones I'm going to talk a little bit later on, I want to put in your head is that, if a client hasn't got the old cashola at 30 June, that we can use a short-term on-demand promissory note that will effectively be utilised. I won't go into it at this time. I've done that in the past in contribution strategy sessions. But in essence, we've just got to make sure that you can use the LightYear Doc site to do to effectively do a promissory note, as long as it is received by the trustee, which is crazy because the member will obviously issue it, goes to the trustees themselves. It is at the date that they receive the promissory note, which is effectively the date of the contribution, which becomes all important in terms of taxation, which we'll have a look. So what I want to do now is just use that concept. In the past, we've always talked about contributions reserves, contributions suspense, but hat tip to John Apollini, who's come up with a great idea of prepaying super, which is really brings it all together, but it's a very easy to understand concept there for your clients, and I think that's really crucial. So if we have a look, sorry about that. So if we have a look at that prepayment, it's going to be right on point. So your clients want the tax deductions. Again, my preference is super at this late stage and working our way through it. So what I thought we'd do is we'd sit off and we'd have a good look at a case study there, and that's really important. And okay, thank you. So we've got a whole lot of stuff on LightYear Docs up on the chat. So I'm going to look at a pretty stock standard case study. I've got John Smith, who's a lawyer. He's had a good year despite COVID. He's a salary and wage earner. So he's employed by a boutique law firm, earns $125,000 a year. And obviously that gets PAYG tax on the way through, and is expecting a $30,000 bonus to be paid to him prior to year end. On that one, we are going to be looking at obviously making that as a deductible contribution into superannuation. Importantly, from that perspective, is it's absolutely vital, and we haven't got the employment contracts on site yet, but they are coming very shortly. We've got a whole suite of HR and employment documents coming up. We're waiting for LightYear Docs 2, which will be, we're hoping it to be released late September, early October. So they're busy building that at this present point in time. With that one, so when we do have that, it's important that your employment contracts enable a bonus to actually be salary sacrifice. That needs to be put up front in your employment contract. Unfortunately, if a bonus is paid and there's no ability to switch that or make a contribution into super, it can't be paid into super as just a very old tax office ruling around Part 4A, can you believe it? So just be careful about that. Again, I'm just wanting to make sure that you are really on top of all the tenets that are required for this solution, this prepayment solution. He has his own self-managed super fund. Unfortunately, going to see the prepayments doesn't work with a retail or industry fund. They barely got enough facility as it is to look after or take contributions in and put them into your account in on time, let alone starting to build suspense accounts for prepayments. It's way over their pay grade. So again, it's another benefit of having a self-managed super fund. If you've got clients who potentially have got family trusts, and we'll talk about that a little bit later on, you've got your SMSF established, but they haven't got a full coterie of members, then we can obviously add members prior to year end and enable contributions. Obviously, you can't put a member in post 1 July and try to make a contribution at 30 June. This is not backdating of contributions, it's a prepayment, which is absolutely crucial. So today, out of his $125,000, his employers put in $10,000 in super. Under SGC, probably should be a little bit more, but just for the sake of our case study, he's put in 10,000 super. Importantly from that, he is living in a nice property valued at $1.5 million with a $450,000 mortgage, but he's refinancing that property in order to open up a credit line. So has been looking at getting into the investment property market, which everyone is doing at the moment. And property prices seem to be super hot. I'm not sure what it's like in your area, but up Sunshine Coast, it's absolutely going crazy. So what we're going to do is look at initially that $30,000 bonus. The problem is if that goes into his hands, and of course it depends on what his cash flow requirements are. But if that $30,000 bonus goes into his hands, obviously he's taxed at his marginal tax rates and he'll be left with a net amount there. Alternatively, we can transfer that into our superannuation by way of a prepayment. He's already made $10,000. So if we look at that, 10,000 plus 40, it now means that he's got 40,000 contribution coming in this year. Importantly, you'll see when we get to the tax deductions, the contribution, in order to get a deduction, it needs to be made. So the contribution needs to be made. Cash is received. If you've got a client who effectively has got a bank account, hopefully they've got almost the instantaneous transfer. But if you have to wait 2 or 3 days and goes into next year, you're really up against a short straw. So if there is a timing issue, remember, we've always got promissory notes. So we've always got promissory notes that can handle it. The benefit of this, of course, is that the $30,000 will be paid straight over. So that will be, there won't be any PAYG tax. So already he's much better off. The tax man is obviously missing out on that PAYG tax. Aldo DeLuca, really good question. Can an individual who's been disqualified from being a trustee of SMSF join another family member's SMSF? Unfortunately, no. If you've been disqualified from a trustee, ordinarily, you would think that, and many of you have heard me talk about the ability of your enduring power of attorney to act as your replacement trustee or replacement director. Unfortunately, section 17A, which is the SMSF definition, 17A10 precludes us from using an enduring power of attorney. So that's unfortunately, Aldo, that is one of the issues, is that we've got a position of a client who's bankrupt or disqualified. That doesn't mean, of course, though, that Aldo, the commissioner can give special dispensation in order to enable a person to become a trustee or a member. So it might be worthwhile just going through that process. Anyway, we're looking at $40,000 contribution, maybe even taking a little bit more, but let's just focus in on that $40,000. Now, we know for this year, 30 June, the cap for concessional contributions is $25,000. Now, if I've got a mechanism to prepay, then obviously I'm not going to keep the whole $40,000 in this current year, because obviously I'd end up with an excess concessional. So that's a whole different ballgame. You know, I still believe in it, and I'll talk about it a little bit later on. But I'm just looking at the really basic ones for you guys. So just remember, it's $25,000 per person, and it can be an amalgamation of both employer and also personal contributions. So the old 10% rule that we used to have doesn't apply. So effectively, we could be in a position, like take, for example, in this instance, and I wouldn't do it in this way, but we've already got $10,000 going in. Does everyone follow that one? The refinancing that he's done, he's going to get a credit line in early July. So I could just take that bonus as cash, salary and wages if I wanted to. Unfortunately, I'm prepaying the tax office that PAYG tax. Does everyone understand that one? But I could do a drawdown from my credit line of an amount to make a personal contribution. So $10,000 could go in from the employer. And then you'll see, because I want to make up this year, I could put in $15,000 this year, and then I could prepay next year's as well as a personal deductible contribution. Next year, you're probably well aware the concessional caps have gone up to $27,500. So if I just had a look at his own capacity, and there's a few little things we want to talk about here, is the employer's put in 10. If we're prepaying, so he can cover off this year, which is another 15. Does everyone follow that one? And then there's another $27,500 he can prepay, put into his self-managed super fund for next year. So $27,500 and 15 makes $42,500 he could pay. But if he hasn't got the cash because the credit line is not being implemented until early July, then what we would do is we would do a promissory note for that $42,500. Has to be on demand, goes into the superannuation fund. Then the superannuation fund would go back to him and receive that payment. It has to be within a short period of time after year end, or once that promissory note has been implemented. So if there's any questions, just put them up on the note, and I can cover off that. It's a really important one. So let's go down and start to have a look. So what are the action steps? What I've done is I'll just go through these action steps, and then we'll come back and look at the law. But we want to do our prepayment of super email. So I've done an email, a done for you strategy email. So let me see if I can get that up here. So I'm just going in here. All of you have got access to this. Even if you're a PAYG user, you can go into, you see there, our strategy and support center. If you go into there, you can see our top box, advisor client strategy and solutions, Center for How-To Solutions, legal and technical, client emails and data capture. So if I go in there and have a look, and you'll see Grant's email copy all done for you. Now I'm trying to make it as easy as possible for you. So what I'll do is I'll actually do it in fact real time. There's a couple of questions, so let's go through those first. Harry, good to see you, Harry. Haven't seen you for a while. How does the promissory note work, whereas we're told if the cash isn't in the bank at 30 June, can't get a deduction? Really good point, Harry. So what happens there, the Commissioner has issued a contributions ruling where it goes through a whole lot of stuff about when it's made. To get the deduction, I'm going to show you the exact section of the Act that talks about what happens. But when a contribution is made, and as I said, when you have a look at the Commissioner's ruling, what it does there, it talks about it actually being received by the trustee's bank account. And of course, the last thing you want to do is put all this stuff in place and then find out it actually happens later. If you think or you're worried, or it comes to the 29th or the 30th of June, 11 o'clock at night on the 30th of June, you can write a promissory note, and let's say it's for yourself, Harry. You write a promissory note for yourself as a member. You do it on the LightYear Doc site. Give it to yourself as a trustee. Acknowledge the time of when it was received. Make sure it's signed and executed, of course. At that point in time, once you receive it, it is treated as a contribution being made prior to 30 June, even if it's at 11 o'clock at that time. Importantly, from that perspective, it needs to be payable on demand and has to be paid within a short period of time. So if the money hits the bank account later on, you can always adjust the entries, and I think that's fairly crucial. Is the prepayment using the reserve strategy? Alkesh, absolutely. The only problem is you're going to see the Commissioner doesn't believe there's any such thing as a contributions reserve. So it's absolutely crucial on that one, that when we go down that track, I'm going to show you exactly what to do. We're going to look at the ATO ruling, etc. But in the meantime, what I want to do is I'm just going to send an email to my best client, which is Michael Jeffries, and we're going to, we know he's got a really good, a lot of taxable income. So let's just go through here. So below is an email for your use with your clients about prepaying contributions and not having a problem with the concessional, non-concessional caps. The strategy automation for preparing the relevant documents can be found here. So that's the contribution suspense. On how it works, you can find that, and obviously I'll put that in there as well. Use this, how to use this email swipe, and swipe just simply means you just take it and do it. So what I do, what you've got to do is simple, take the headline below, paste it in the subject line. So what I'm going to do here is I'm going to take that, and then I'm just going to open my Outlook, and I might do, in fact, what I might do it to my good mate, Tony Anamoulis. So I'll do that to Tony, subject line. So that's okay. So far, so good. That's pretty easy. I'll go back to my site, and then I've got here, you may not be aware, the Commissioner has told accountants that their superannuation clients, the business or the taxpayer member of a super fund can prepay deductions. So we're talking about the $52,500. How does it work in practice? There's a prepayment case study there. Interested in paying less tax in 2021, can be used with employees and individuals. If you'd like to see how it plays, it's up to you if you want to pay tax or not. So I just simply do that. Have a look at the copy. Of course, you can change the copy, but I've been working with a couple of people on that. And then I can put Dear Tony, and then I just copy that in there. And then, of course, I can then just send that off, and hopefully he will come back on that particular one. So if I go back to my case study here, so what I've got there is I've got my prepayment of super email. So you don't have to do much. Get one of your staff, just to simply, if you've got a MailChimp, send that out to all your clients on MailChimp. If not, if you can go out to Outlook, get one of your junior staff just to simply send it out. And it doesn't matter whether they use it or not. It's far better to provide them with, specialist education that provides value to them and solves a specific solution. And that's absolutely crucial. One is it shows to your clients that you're coming up with solutions to help them to reduce their tax. Secondly, it brands you as a strategist because they wouldn't have heard this sort of strategy before. So that's absolutely crucial. So we've got to obviously send all your clients a prepayment. The second one is determine the amounts. Now we talked about it before. We've got, $52,500, which can potentially be taken as a tax deduction per person. So if it's, we've got a family trust, we've got a husband and wife, or spouses, I should say, or partners, that can jump up to, $105,000 with the two of them. If they've got their parents in there and they're, the parents are, underage, if they're working, they're under age 75, then effectively they can also take the same thing, and also children as well. So if we have a look at that, we're in a pretty good position, from that perspective. So I think that that's absolutely crucial. And, from that, if we have a look at that, that really starts to open up the slather if we have a look at that. Now, if you're an accountant, you have to fit in with exemption for tax agents in Asset Guidance Note 216. I'll put that in the notes for you to have a look at. We haven't got time to go through that in this particular session, but essentially when we have a look at that info guidance, we are able to talk to our clients about the tax deductibility of the contributions, the prepayment, the SIS compliance, the SMSF. We can't go down and specifically talk about the exact amount. But again, if we can talk to the client that the maximum tax deductible amount they can get if they do this prepayment is $52,500. So then it's up to the client to make that choice, if that makes sense. But I will actually put these notes for the asset guidance into our strategy centre along with this webinar. I want to give you as much information as possible. With your deed, make sure, and I'm going to take you through this. So if we have a look, there is check the deed or upgrade it, which is important if they don't have the ability to do a contribution suspense account. So again, we're going to have a look at the Commissioner's ruling, and he says that basically this is not a reserve, and you want to be with that because he's sort of coming down hard on reserve. So if he gives you an open gateway being suspense accounts, basically take that. Build the documents on the LightYear Docs platform. I'm going to show you exactly what it looks like, how to do that. And again, the documents I build, I'll show you there. Obviously, render your invoice. What are you going to pay for this? And then obviously, because we're prepaying next year, we've got to watch out for next year's caps. So I've got a couple of good questions. Does this work even when the client is over their cap, the $1.6 million members account? Absolutely, because what's happening here is generally, if we have a look at our superannuation or general superannuation balance, we can't make any non-concessional contributions over that into the super fund if we've already hit that general superannuation balance. So from our perspective, what we're only dealing with is the cap amounts, because we're using this year's cap and next year's cap by way of a prepayment. If we go above those caps to obviously go into excess concessional, then excess concessional are also non-concessional. So we'd hit a bit of a roadblock there. So this works absolutely perfectly for people who are hitting their $1.6 million general superannuation balance, which is a great question. From Sam, thanks Sam. Potentially more if there are unused concessional caps from, absolutely, thank you for that Sam. In fact, Sam raises a really important point. I'm assuming there, of course, that in this instance, and again, thank you very much Sam, really on the ball there. I always forget this one, even though I talked about it a couple of weeks ago. If we've got our unused concessional contributions cap, we can obviously use that one this year as well, plus flick some into next year. So we can do, in fact, there's 3 strategies we can do. One is super for this year. The next one is obviously our backtrack of our super, or bring forward those unused superannuation contributions from the 1st of July 2018, and then obviously the bring forward. So in this instance, for our client, if we go back, if he hasn't used or hasn't made super, we'd have to go back and determine, well, this is the amount from prior years, this is this year plus this year. So when we come around here, accountants, we can actually say we've determined from a tax perspective the maximum amount you can put in without breaching the caps from the past utilisation of the caps. Current and prepayment is going to be X dollars. And if you're a tax agent, you're going to find that will not breach the licensing rules. So you don't need to be licensed to do that. Importantly, if you're a planner, absolutely you're going to need to do a limited statement of advice, David. So that's the painful side of the equation. If you are a planner or you do have a limited license. For those of you who got limited licenses as accountants, I'd strongly suggest you have a really good look at that info paper 216 as to see what you can and cannot do. Okay, so let's start to move down the track and go through the law. So we always look at the trust deed. We've looked at the Corporations Act already around licensing. You obviously are planning, you have to do a limited statement of advice. If you're an accountant or a tax agent, you can latch on to talking about the compliance. You can talk about the tax deductibility or the maximum tax deductibility a client can offer. But again, you know, the client has to determine what that maximum amount is. Now what we do is we want to have a look at the deed, we're going to have a look at the SIS Act, and then we're going to have a look at the Tax Act, and then I'm going to build it for you. So the first thing is, look, I haven't seen many deeds that talk about contribution suspense accounts. Most of them are still up with contributions reserves, and it's primarily there was an edict issued by the Commissioner in 2019 that talks about it. We'll talk about that shortly. But in the LightYear Docs deed, and again, for those of you who haven't, you really haven't had much education around deeds, you'll see their changed GPS down below. From the 7th to 11th of June, you would have got information from us or SMSF Advisor. Make sure you can get to that Trust Deed Awareness Week, because we'll be going through a whole lot of stuff, including SMSFs, leading member SMSFs, discretionary trust, leading member discretionary trust, which are particularly useful for bloodline perspectives. We'll be looking at testamentary trusts. So make sure you book in for that. It's 1 to 2 p.m. all next week, starting Monday and ending up on Friday. So it's going to be a great session. And we've got a couple of lawyers who are family lawyers and also insolvency lawyers, which will be a lot of fun, because we'll be getting in and all having a bit of a joust about them. We're going to find out how they attack it, and then we'll go from there. So the suspense account rule 5.3 is in our deed. The trustee may accept an asset, monies, payments, in-kind benefit, distribution, or such other amount as described in rule 4.1. So that's the contributions, and at their discretion, unless otherwise required under the super laws, may hold these amounts in a suspense account before credited to an account or member superannuation interest. There is no limit unless the superannuation laws otherwise provide as to the time any specific amount is held in this suspense account. Any suspense account, the trustee may create as many as they choose, may have its own investment strategy if the trustee so chooses, which is going to be very unlikely because it's virtually an in and out. And as I said, make sure you make it to the Deed Awareness Week. Just on that one, for those of you who are our users, I've got a session tomorrow at Thursday at 12:30 where I'll be going through the ins and outs and on testamentary trust. It's going to be a really high-level training. If you want, I'd encourage you all to obviously go to our SEPEPA accreditation advisor course, where we'll be doing a lot more deep diving. But tomorrow in testamentary trusts, I want to show you why testamentary trusts through a will are really problematical these days. My preference, particularly with super, is to build a testamentary trust with just superannuation monies that doesn't go through the will. So you've got specific power to do that. And the same with insurance proceeds as well. And also be talking about how to deal with living trusts versus a testamentary trust. So we'll show you how to go through testamentary trust. And we've got a brand new data capture, actually. It's called, you're going to be loving this one. So hopefully all of you turn up. But I've written a little mini book. It's only around about 15, 16 pages long. It's called The Guide to Testamentary Trusts, and it's got my name on it. And of course, if you're one of our users, you can also put your name on there as an author as well, and it goes into a data capture. So it's a sweet little baby PDF book that I'm more than happy for you to put your name on and get it out there. So again, we'll go through that tomorrow. So if you've got time, I've got Michael Jeffries and Tony Anamoulis and also Tim Munro coming on tomorrow. So it's the four strategy amigos will be there together. So we've looked at the deed. We're comfortable with the deed. If your deed doesn't do it, look, you're crazy not to. Really, with your clients, upgrade the deed. It's either a standard SMSF deed with LightYear Docs or our leading member one, which is for bloodline purposes. So we've checked the law. So now we go to the tax office. I want to find out that, we had the talk before about this contributions reserve. So if we have a look at SMSF in 2018/1, so it came out only a couple of years ago, 2 or 3 years ago, the use of reserves by SMSFs. Really, Commissioner didn't worry about it to any great extent because of any allocation from a reserve is generally a concessional contribution. There are some exceptions like the 5% rule, and particularly if you're looking at replenishment of pensions. But one of the big concerns there from the Commissioner in this regulatory bulletin was the utilisation of reserves to take money out or basically take earnings into a reserve. Thereby, the question was around about the cap. I mean, most of our clients have got their general superannuation balance or their transfer caps up because of earnings. And you think about it, particularly in the last year or so, if that were just stuck into an investment reserve, which the Commissioner does say it's not there's nothing to prevent you doing that, then obviously we can monitor the amount of concessional going in, if you understand what I mean. But that's a completely different session. I might do a reserve session sometime down the track if there's enough people wanting to it. Anyway, let's have a look. I just pulled out, you can see paragraph 44, 45, 46. Can I use a reserve to hold unallocated contributions? So remember what we're doing with John in this instance. He's already had $10,000 gone into his account, so that's already allocated. We're going to put in another $30,000, and so we want to keep up to his cap. So that's $15,000 we allocated. The remainder amount, the other $15,000 of his bonus, will then be taken to will be an unallocated contribution because we don't want it to go in his cap. But bear in mind, obviously, all has to be received before 30 June. Paragraph 44, you can see it here while I'm having a look at it. We understand the suspense accounts to used to hold contributions pending their allocation under Division 7.2 of SIS Regs, which we'll look at, to an accumulation interest of a member, commonly referred to as reserves. Consistent with APRA views in SPG 222, which again on my training I'll go through, we do not consider these accounts as reserves for the purposes of a SISA and also the SIS Regs. However, we consider that the meaning of reserve is broader for the purposes of Regulation 291-25.01 of the Income Tax Assessment Regulations, or 1997. So he obviously wants a bit of both ways. That's why I think there's an issue there. And for that purpose would include an amount held in this type of suspense account. The inclusion of these contributions in either concessional contributions or as non-concessional, so again, he's also talking about, I'm only talking about concessional, but you can use these for non-concessional. So for example, we know that in this instance with our client, he's got a credit line there that's coming in a little bit later on. So if he wanted to maximise his non-concessional, so he's going to really dump as much as he can in this year, what do you think the total amount is going to be? So he's going to put some money in this year for non-concessional, so we're outside concessional, and the rest is going to carry over into this unallocated contribution suspense account. Well, when we have a look at that, there's going to be 100 this year, but remember, next year, the non-concessional cap goes up to 110. So effectively, you can put in 100 plus 330, which is a 3-year bring forward rule, to put $430,000 in this year if he wanted to do so. Again, the Commissioner, how do I know that? Because the Commissioner is telling me that in this guideline. Now let's go back, and these contributions are included and accessible through 291-25.01 of the income tax, or non-concessional contributions through sub-regulation 292-90.01. So again, they're not treated as concessional contributions if they're from non-concessional. SMSF trustees are able to accept contributions to these accounts pending allocation of the relevant member in accordance with Division 7.2. So let's go and have a look at Division 7.2. This is straight out of the SIS Regs. It provides there under SIS Regulation 7.08 for subsection 31 of the Act, which basically says that regulations may be made in terms of contributions. a trustee must allocate the contribution to a member of the fund not later than 28 days after the end of the month, or if it's not reasonably practical to allocate the contribution to a member of a fund not later than 28 days after the end of the month within such longer period as is reasonable in the circumstances. So again, this is one of the issues that we obviously don't want to prepay super in May because I'm going to have to allocate in June unless I can get under sub regulation B by trying to defer it. But if it was made in December, then there's no way in the world I'm going to be able to defer it for 6 months. So again, how do I know all this? Because the Commissioner has told me so. If we then go on and have a look at the tax deductible rules, so you'll see here, Section 290-60, employer contributions deductible. You can deduct a contribution you make to a superannuation fund or an RSA for the purpose of providing super benefits for another person who's your employee when the contribution is made. And remember, made, we've talked about that. For this one, cash actually has to be received. And then 2, however, conditions in subsection 290-70, 75 and 290-80 must be satisfied, and that deals with age-related contributions. So you can't make it more than 75 years and 28 days. Here's the important one. You can deduct the contribution only for the income year in which you made the contribution. So remember, we're talking to employers. Now note there is no discussion around the cap. So for example, unlike the age-based limits, the employer here, the caps are an individual thing. So it's a member thing, it's not an employer thing. So the employer in this instance, our boutique law firm's already put in 10. We've now got John Smith going to them saying, well, can you throw in that other 30? Under the old laws that prevailed prior to 2007, you'd be limited by limits, obviously whatever the limit was at that time. In this instance, the whole 40 can go in because you can see there under 290-60, there's no cap on the amount. The cap actually applies to the member, not the employer. Likewise here, if you have a look at it, Section 290-150, personal contributions are deductible. The same thing, you can deduct a contribution you make to a super fund or an RSA for the purpose of providing super benefits for yourself. And again, there's a whole lot of conditions there. Again, that has to be made for employees, for children. If children are employed, even if they're 12 or 13 or 14, superannuation contributions may be made on their behalf. You'll see also up on our strategy centre, if you just go and put child contributions, effectively I did a session on last week, that children can make personal deductible contributions, but it has to be set off. They actually have to prove they're either in business or they've been employed. So that's the tax deduction side that we're having a look at. Obviously, there's going to be issues around the caps, etc. Okay, so there's a few twists there. So let's just bounce out of there. And what I'm going to do is I'm going to go down and actually build the documentation for you and show you what it looks like. So now just a couple of things here. I've got LightYear docs here. For those of you who have problems this year, you can see this week, you can see here, unfortunately, Google changed the cookies in the system, changed security settings. And you can see, for those of you aware, we've got our LightYear Docs site, and then we've got internally our Hot Docs engine. So they both sit on different servers. And then what happens is that effectively they talk to each other. But Google is put up a security patch that doesn't enable them to talk to each other. So you can still build the document, but what happens is when you go to finish it, you'll get this interview session expired. We've gone to Google and looking for a patch, but this has an impact on quite a significant amount of sites. Like I love SMSF.com, GrantAbbott.com have equally been affected. What we've found though is obviously we're moving to LightYear Docs 2, which is coming up in September, October. We won't have that specific problem, which is fairly important because of the way we're designing it. So at least we're having foresight with that. For those of you who may not be shareholders in the LightYear Group, and I know many of you are, we are doing a small capital raising to finish off that particular allocation. If you'd like to get involved or find out that information, it goes out tomorrow. Contact Michael Jeffries. So just michael@lightyeardocs.com.au. So it's michael@lightyeardocs.com.au. And it's worthwhile. I mean, in the last month, we won the Startup Business of the Year under the Australian Digital Technology Awards. We also came 6th in the SMSF and Wealth Management section, and we beat some big players, including, for example, Xero. In terms of Telstra, we've just been nominated as a finalist in the Telstra Small Business Awards in the Innovation section. And I love accounting, where Michael's also got a business is placed it's in the top 3 in the finalists in the Australian Accounting Awards. So really starting to hit our straps. And if you're keen on investing in the company, I think it's extremely undervalued at the moment. When you have a look at Now Infinity was sold for $25 million. And this, I believe this is much better than Now Infinity. And there's been a couple other doc solutions that have gone up to $102 million in terms of sales. So have a look at that. Getting back to the story. So what I've got to do here is instead of that, we've found that Firefox works. You can see here I've already prepared a contribution suspense. So I'm just going to take you through that, then show you through the documents. So again, you can just jump in, prepare the document. If I wanted to do that, I could just go into the best thing to do. In fact, probably don't even do that. Just put in suspense, and then up will pop the contribution suspense account. So you can go in and start the document, go off and running. But just to save time, and you don't want to see me typing, I'm going to go into my document storage. So I did one earlier. You can see here it's in Abbott Test. I'll put in there just so we can find it. I'll put in here suspense. And then there we go. So the Smith suspense account. So I built this earlier today. In fact, you can see it was only built half an hour before I even started. So again, you can see up comes the hot doc system. The new system we've got is absolutely unbelievable. And I want to show it to those people come tomorrow. The data capture we'll be doing with the testamentary trusts and all of our data captures, investment strategies, etc. You'll be able to send them out to the client. The client will be able to complete them and will actually fill in the form for you. So that's absolutely essential when we're coming around to doing wills and EPOAs, because effectively you're not really touching the document. The client is actually generating the document for you. So that's a really exciting turn of the events there. And again, technology is enabling all of us to take a greater hand in the legal affairs of our client using a really strong back engine. We have been doing it for such a long time with trustees, companies, etc. But now we're taking it to that next level. Loan agreements. It's funny, I was dealing with a client, some accountants yesterday who outsource loan agreements, leases, the whole thing to legal firms. And it just seems to me to be crazy when you can be building it all on our platform. Anyway, the name I've got there is the Smith suspense account. I'll put in the Abbott Mourly tag logo. You can put in your own one there because it's a contribution. It's not really a legal document. It's a set of minutes. We put in the name of the super fund. I've got the Smith Family Super Fund. I can do there, if there's more than one member, I can put in the name, the number of members there. So for example, if I've got a family trust and I've got John and Sally Smith, who are both employees, and also their dad Ruth, their mother Ruth, their dad Joe, and their kids, we can also put those in there. And if they're all employed, they can make those contributions. As you saw last week, in terms of making contributions, it doesn't matter how much they work. The superannuation contributions you can make are virtually not unlimited, but within reason. They don't have to be commensurate with the amount of work performed. There's been some cases on that, and the Commissioner's got a ruling on that it doesn't breach Part 4A, and it's all okay. But in this instance, I'm just going to make it from one member. So it's for John Smith, and then it goes into the super fund. So I've got John Smith and Sally Smith. So there's no shake in the tail there. Again, with LightYear Docs 2, unfortunately, this system here, we haven't got really good, strong APIs. With LightYear Docs 2, we'll be able to pull in data from BGL, their 360 Simpler Super. So that'll just pre-populate that. Okay, so let's go down the process, and if we have a look at it. So the first step is there needs to be an application by the member to the trustee of the fund to put monies into the suspense account. So in this one, we've got a trustee meeting in which there's an application on behalf of the member, which is going to be John Smith, in respect of his employer contributions from a boutique law firm. So we've got all the details around the fund, so there's not a big drama there. So this is the application. The next one is we've got who's the contributor. In this one, we've got boutique law firm. If there's, of course, if it was an individual, we could just use John Smith if he was making his own personal contribution. So I can do all of this and run it through with the employer and then come back and run it again with the individual in exactly the same scenario if I want. Remember how we want to go up to that 52,500. But just for this example, so what I do is I complete the one for the company, I'd finish it and then relaunch, and I'd go back and do the individual. My preference is probably to set up quite a separate one there. So we've got the boutique law firm, and again, the only issue you'll have there is if, remember, this is a $30,000 contribution coming by way of salary sacrifice from the law firm. So we need the directors of that firm to sign off. And I've got John, Fred and Bob Judge. Now, we only need a couple of directors to sign, so they're going to sign that on behalf. Now, obviously, if it's a family trust, it's easy. If it's a really large company, then what we need to do is we probably can just get away with one director for that, or if there's going to be that issue, let me know, because again, we can adjust our documentation pretty well. All we have to do is we can just put that in without getting a signing. So there's just building that contribution suspense account without the documentation. Here, it makes sense and it's much better legally to obviously get everyone to sign it. Okay, let's get down to the meat. So please enter the details of contribution below. The contribution will be placed in contribution suspense with a subsequent allocation as required under the super laws. So please enter the date the member will be applying to the trustee for the establishment. So I've got here the 25th of June. It doesn't matter, we could actually choose, we'll choose today's date. What is the date of the intended contribution? I've got 26th of June. Let's go and have a look. So that's on the Friday. You just got to be really careful about that. It's going to be a disaster this year if people try to put in on the 29th or the 30th. I reckon it's going to jump over into July and the whole strategy will go down. So again, you might need to have promissory notes, but in that instance, just make sure that the contribution's received. There's plenty of time there around that bonus. So what is the contribution amount? Well, it's 52,500 is going to be put in. The allocation amount is 27,500. Now, what we're doing is we're building another one together. So the logic here is, what's the date of the allocation for the suspense account? Remember, Div 7.2, it has to be made by the 28th of July next year. So what I've got here is the 16th of the 7th, but if you want, you can just simply make it the 1st of July is the allocation. The amount to be taken to the contribution suspense account is 27,500. So that's the sort of amount here, but remember, we can build it for multiple members. That's why we're effectively doing it. Now, you can do that for concessional and you can also do that for non-concessional. So here, I've chosen concessional contributions. Now, what happens is we need to then have a trustee meeting for the allocation of the amount. So we've had an application, we've then had the trustee meeting, so we've been put on notice there. And then finally, we're having an application we're having an allocation meeting from that perspective. So we're going down the track. We've got there John Smith, the date of allocation. I've changed that to the 1st of July, and then we're off and running. So what will happen in Firefox, and this is probably why that Google patch doesn't happen. You don't stay on the page, you actually have to leave that page. So it takes you from one server to the other. So it's actually pre-built in with Firefox. So that's why the Google doesn't apply. So, in 3 or 4 months, we're going to be working with a cracking new system. So we don't have to worry about all this stuff, thank goodness. I'm going to open up that now for us. So you can see here, I've got a chance to open up in Firefox or Nitro Pro. I'll just open it up in Firefox. I've got a couple of questions here, so we'll have a look at that before we go on. Okay, so let's go in, have a look. Who do we contact for investment in the company? I'll just put that in there. As I said, we're really hitting our straps, and the only problem is getting ASAP because we've got a couple of big players who are really interested in coming in, and the allocation is almost pretty full. So I'm just putting, if you want to contact Michael, just jump in the chat. You can see there, michael@lightyeardocs.com.au. So go and have a look at that. So how do you get to tax deductions up to $102,000 for each person as stated in the promotional email of 30th of May? Okay. So in fact, I'll cover that, Greg. In fact, I'm going to have a look at that very shortly. If you just bear with me, I'm going to show you how to do 102,500 in 1 second. So just leave that with me. I've just got to go through this, then I'll show you exactly how to do that. We are in the 2021 year, allowed 2 days for transfer. Absolutely, if you want. The only thing is, that's a really good position, John, because you're probably going to be on some whiz-bang holiday. So wait for the allocation to come until you come back. But effectively, it's the allocation, although you may not record it in the books of account, effectively it's done when it's done. So you're probably right, John, it's much better to wait until you come back from your holidays. Just make sure you get it in before the 28th of July. So we've got a contribution suspense account for the Smith Family Super Fund. Now, what we've done is just so your clients are well aware about reserves and suspense. Wherever we can, we always put in that that amount in there. We put in any ATO rulings or whatever, and you can see that all throughout our documentation. It's far better for you to have this as part of the package, so the client can't say, well, hold on, you didn't tell me about this, because essentially it's part of the package. So we got the whole reserves bulletin there. As I said before, we go down, and remember it was paragraph 44. So just to show you that we've got there. So this is the section that we effectively use. Remember that one? So we've already been through that one. Let's go down and have a look at the documentation there. So we've gone through the end there. Now, application by boutique law firm to contribute to a contribution suspense account. So we've got John Smith, we've got the contributor's name. They're putting in 52,500, concessional 27.5 that's going to be taken to a suspense account. So I didn't use the 10 and the 30. I've actually gone up the full 52,500 just to show you. Now, what I've done is the contributor, being the employer, has obviously signed. If you have got, please let me know if you've got large firms or large employers doing this, then what I can do is I can take that out and put in a different signing, so it still comes from that. Like if it's BHP, I can still cover it, but I need to know that from you up front. But if it's a family trust or whatever, you obviously has to be signed by the contributor. If it's individual, if it's an individual doing it, obviously it'd be John Smith who would be doing it there. So we've had the application, we've received the application, and then it goes to the trustee meeting. So the application there is the 3rd of June. The trustee meeting considering it is on the 25th of June. So again, we've got John and Sally. So this is the trustee. The contribution amount, so boutique law firm is applied to pay any following amount. And you find there if you've got multiple members, it all come down as multiple members. The date of the contribution, the 26th of June, concessional, and the amount to be taken to a contribution suspense account is 27.5. So again, we sign all of that. And then finally, there is the trustee meeting. And as John said, probably 1st of July is a little bit far-fetched. We might want to go, say, to the 14th of July, Bastille Day. So there, the allocation amount from contribution reserve account to John Smith. So we've got essentially all that there. So that's your, that's essentially the whole suite of documents there for that contribution suspense. Again, you can put in multi employees if it's an employer, and we've seen that as well there. Obviously, individual, you can do concessional at one stage, and then you can go back and do non-concessional. So let's go back to the slides. Someone said, we talked about 102,500, which I'll look at. In fact, I'll show you could probably even do it more than that if you want. So for me, there's really no end in the taxable income. So when we have a look here, you can do both personal and also employer, but you need to separate the documentation, although I did show you how you can do both in the one program. The only problem is when you come back and relaunch, it overwrites the earlier one. So just make sure you've got a soft copy and potentially a hard copy of the first set of documents. For employer contributions, actually can have a number of members there that you can put in, and you can allocate to specific ones. When it comes in, if it's an employer, for example, it might be, as I said, John, Sally, what did I say? It was Joe, Ruth, and also the kids. Obviously, you can't do that all into the SMSF yet. The 6-member rule hasn't quite made it yet. Then if we are putting in, we're looking at 27,500, we're looking at 5 lots of that. That's effectively $110,000 we can put in. The allocation, or how it's to be allocated, doesn't come in up front in terms of claiming the deduction. It comes in when we do the allocation. And generally you'll do 27.5, but potentially I'll look at it a bit later on. Concessional, also non-concessional, we talked about family trust. Now, if John went up to 102,500, what would happen? So let's just play it out. So again, for this year, he's got $25,000. So that would mean that if he's got $25,000 this year, then effectively he's going to be up at 77,500. So that's right. 77,500 will be taken to a contributions suspense account. Everyone will be on that one. So I'm taking the 25, and then I've got 77,500, I think. Actually, let me just do my figures. I think I'm pretty hopeless there, and I hate to do it. So what I'm doing is I'm putting in 102,500, getting a tax deduction for it this year. I'm going to show you how to do it a bit more if you want. And again, I'll send a link to I'll send a link to you to show how to even make more of that a little bit later on with our stuff. So in terms of the calculator, so you guys are probably laughing at me, but that's what happens when someone's got a legal degree. So minus 25,000, which is this year. Okay, yeah, so 77,500 goes into that contribution suspense account. Now, what will happen is next year, so we've used up the allocation, so we've prepaid 27,500, which is our cap. So we've now got $50,000 for the year ending 30 June 2022. So it's 30 June 2022, which will be added back because it's excess concessional. And you obviously remember I said you can't do excess concessional, which are also treated as non-concessional if you're already up your general superannuation balance of 1.6. So that extra $50,000, what will happen, we get a deduction this year, but that extra $50,000 will be added back to John's assessable income for the year ended 30 June 2022. So again, that extra $50,000 that we put in will be added back to John's assessable income for the year ending 30 June 2022. What will happen then is John will lodge his tax returns in May 2023 for both the super fund and also his personal income tax returns. And there's a special form if you're doing concessional contributions, which I'll leave on the side. I'll link in our materials you'll get today, which shows you exactly what's required for the commissioner when you're completing a return on concessional contributions and you're using a suspense account. So again, the commissioner shows you exactly what is needed to be done when you're lodging for your clients. So anyway, that $50,000 is added back and it's brought to account at his marginal tax rate, but it has a 15% tax offset. So let's say, for example, next year, John has a year off. Now, it's very unlikely, but let's say he has a year off, so he has no taxable income. Then effectively next year, his assessable income will be the $50,000. You work out tax payable on that, which I think is going to be, what, about $5,000 or $6,000, but he gets a 15% tax offset on that, which is $7,250. So he's not going to have to pay any taxable income. Unfortunately, that offset he gets can't be carried forward or carried back. So we need to have a look at that. So quite apart from 102,500, in fact, we could go to 152,500. Because again, if we have a look at it, the add back, if he wasn't working next year, that $100,000, we add it back to his income. We go to May 2023, the Commission will issue a notice, work out your tax payable on $100,000. That's the add back. And then he'll get a 15% offset, which is $15,000 a tax offset. So he's not going to have to pay much tax on $100,000. And it can carry on. I mean, you can go up to a couple $100,000 if you want. You just got to be careful. And this is where it's important for you just to be able to get a little spreadsheet and work out which is the optimal amount to carry forward, particularly if someone's retiring, leaving a job. And remember, these are personal deductibles. So if you've got a big capital gain this year, you can carry it forward and defer it to next year. So these are absolutely crucial for that one. Just be careful again. We're moving towards the end of time. I want to make sure we've gone over a little bit. But again, just be careful about that. There's no limit. Remember, we had a look at the deductible contributions. There's no limit on personal deductible, no limit on employer. So again, just go above, just be wary of the add back. There are no penalty taxes anymore. It's added back to assessable income with a 15% tax offset. So that's a pretty good position. So anyway, and there's obviously the excess concessional contributions charge, which is about, I think it's about 4 or 5%, but based on your tax liability. So if you're virtually not paying your tax, there's no ECCC. And again, it's the same thing if you're employing your parents. And again, we can go down and use the Commissioner's guidelines on concessional contributions going that are not commensurate with the amount of work done. We again put in large amounts there. The beautiful thing about the parents is if they're already over age 60, they've generally probably met, or 65, they met a condition of release so they can access that super. Anyway, that's a really time sensitive. Start with, again, going back to the actions there, what we've got there. We've got send that super email. So anyone who's got tax, get your, obviously get your staff to send out that email. You haven't lost anything, get on the blower, work out what it is, and then go through that process. I'm not sure what you would charge for that, but I would say that if you're doing that prepayment, it should be between $2,500 to $3,000, depending on what you've got. But anyway, thank you very much for attending today. Today we'll give, I think there's a half point if you're in FASEA, for those who are planners, limited licensing accountants. There's half a point technical, half a point client care. I think we can also give you 1 hour, one CPD point for the SMSF Association, and also one for those of you who are tax agents under the Tax Practitioner Board. If you haven't seen it yet, we've now got a CPD tracker that does all your CPDing for you. Good to see you, Mr. Samu. I'm sorry about the lockdown in Melbourne, tragic thing, but hopefully you'll be out of it within a short period of time. Anyway, it's Grant Abbott. Thank you all for attending, and we will see you hopefully tomorrow for a really great look at testamentary trusts. You'll absolutely be blown away with what we've got. And wouldn't it be great for you to be an author in the book, The Guide to Testamentary Trusts? It's Grant Abbott signing off.